Today, the impossible equation. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 2nd of March 2019, our digest of the latest finance and property news with a distinctively Australian flavour. We live in a weird world where the financial markets seem disconnected from the real economy. For example, locally, home price data continues to fall and future company earnings are under pressure, yet the markets are just shrugging this off. But we need to understand this disconnect and why, when a crash comes, it will be more severe. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or consider joining our Patreon program. Again, here is the link. We really appreciate your support to help us continue to make great content. And the links are also in the comments below. So let's start with the latest data from CoreLogic on home prices. On a national basis, the CoreLogic Home Value Index dropped 6.3% year over year and 6.8% from its peak in October 2017. It's now back to where it had been in September 2016. Now that said, CoreLogic's report points out that despite the decline, the index remains 18% higher than it had been 5 years ago, highlighting that most homeowners remain in a strong equities position, they say. Only recent buyers are underwater. But on our estimates, that is still more than 10% of property owners and growing. And of course, if households are forced to sell, then they will not necessarily command top dollar and will also have to pay the transaction costs as well. Plus, February being a short month is 1 week less in terms of falls. Across the metro areas of Sydney, prices for all types of homes combined, according to CoreLogic's Home Value Index, fell 1% in February from January, or 10.4% from a year ago, and nearly 13% from its peak in July 2017. And just over the past 4 months, the index has dropped 5.5%. Plus, the volume of closed sales recorded in Sydney in February plunged 20.6% from the already weak sales in February last year, according to CoreLogic's report. Units, generally the lower end of the market, is where first-time buyers are thought to have had a chance, and they were considered the saving grace in this market, but prices continue to drop, and the industry's hope that first-time buyers will bail out the market is now fading. On average, house prices dropped 1.1% in February and 11.5% year on year, and units dropped 0.8% in February and 8.8% year over year. In the Melbourne metro, the second largest market of course, prices of all types of homes fell 1% for the month and 9.1% year over year, according to the CoreLogic Value Index. The index is now down nearly 10% from the peak in November 2017, and over the past 4 months, the index for Melbourne dropped 5%. House prices dropped in Melbourne 1.2% and 11.5% over the year, and apartment prices dropped 0.6% for the month and 3.7% year over year. And CoreLogic estimates that closed sales in Melbourne plunged 22.1% in February from the already weak sales a year earlier. At the bottom 10 sub-regions of Australia's capital cities, 7 were in the Sydney metro and 3 were in Melbourne. And the metros of Sydney and Melbourne, due to their enormous size and high prices, dominate the national home values, but weakness is now spreading to other capital cities, with only Hobart and Canberra still showing year-over-year gains. Westpac released their latest housing polls. One chart tells the story. National housing turnover fell to the lowest level since 2087 in the final 3 months of 2018, while total listings have also increased significantly. And CoreLogic also showed that vendor discounting is rising across the combined capital cities. The median vendor discount is recorded at down 6.3%, which is the most significant discount since January 2009. And in January 2018, discount levels were much less significant at down 4.7%, which highlights just how quickly housing market conditions have deteriorated in the 12 months, with discounting levels mirroring those seen during the financial crisis. Across the regional markets, the deterioration in selling conditions has not been as substantial as it has been across the capital cities. Discounting levels are currently recorded at down 5.2%, compared with down 4.5% a year ago. The worsening in discounting reflects the fact that dwelling values have begun falling in regional markets over recent months. Sydney are seeing more substantial discounts than they were during the financial crisis. The median vendor discount is currently down 7.5%, which is weakened from down 4.8% a year ago. The last time it was larger than it is currently was way back in February 2006. The rate of deterioration of selling conditions in Sydney has been rapid. In Melbourne, vendor discounting has become more significant over the past year as dwelling values have fallen rapidly. A year ago, vendor discounting was just down 3.6%, having fallen to down 7% currently, which is its weakest level on record. Like Sydney, this highlights just how weak housing market conditions are and how few buyers there are. And CoreLogic also released its final auction results, which reported a 4.7% decline in the final national auction clearance rate to 49.4%, below last week's 51.2%. Sydney's auction clearance rate fell by 8.4% to 50.2%, whereas Melbourne fell 2.5% to 50.6%. Overall auction clearances were still 14.9% down in Sydney and 20% down in Melbourne compared with the same weekend last year, when dwelling values were also falling. Moreover, auction volumes were also down 36 and 30% respectively in both Sydney and Melbourne. And I discussed the reliability of the auction clearance rates with property insider Edwin Almeida. See our post, Edwin Almeida, what are the numbers really telling us? Don't believe the hype. There is nothing here to show that the market is bouncing back. Plus, the indices are averages, and there are wide variations on the ground, with falls of up to 40% already evidenced in some areas. And by the way, I get a lot of requests for more local and regional data, so I hope to start a series on this when I can, but remember, from a macroeconomic perspective, the concentration of property in Melbourne and Sydney means that they will drive the broader economic outcomes. We expect prices to continue to fall, and as Wall Street highlighted, there is a bitter irony to all this. For example, back in February 2017, just months before the market in Sydney peaked, Anthony Roberts, the New South Wales Minister for Planning and Housing, was promoting the launch of a 690-unit apartment development at Olympic Park, heaping praise on the developer for having reserved 60 units for first-time buyers. Roberts was hyping new incentives for first-time buyers, including a reduction of the down payment to 5% to lure them into the Sydney housing market. He said, "This is about fairness, and this is about enabling people to get into the Sydney housing market. Once you're in the Sydney housing market, you're pretty well set up for the rest of your life." Well, I have to say that with prices down now perhaps 20%, they will have lost their shirts. And I think also this is now at least an open question thanks to home price falls, which are in free fall. And of course more questions about the quality of construction as typified by the Opal building and now a tranche of other questionable towers across the country. Now, let me remind you again of what the RBA said in their recent minutes, as they maintained the cash rate at a low of 1.5% in their February meeting. From a longer run perspective, members assessed that following such large increases in housing prices, the effect of the recent price falls on overall economic activity was expected to be relatively small. From a financial stability perspective, tighter lending standards, an improving labour market and low interest rates were all likely to support households' capacity to service their debt. And few households were in negative equity positions despite the falls in housing prices, implying that bank losses would be limited even if household financial stress was to become more widespread. But I have to say, I do not regard 450,000 households in negative equity as few. And compare that with the recent IMF stress tests, when they said the financial sector faced continued vulnerabilities from high household debt, still stretched real estate valuations, and banks' ongoing dependence on funding from global markets. The assessment recommended further steps to bolster financial supervision, as well as to reinforce financial crisis management. And we think both of those are an absolute requirement. Now, the latest data from the RBA and APRA show that the credit impulse slowed again in January. The The RBA lending aggregate showed that the annual owner-occupied home loan lending now stands at 6.2%, investment lending at 1%, and overall credit growth at 4.4%. There was a considerable drop-off in personal credit and a rise in business lending. But despite all the funnies in the numbers, lending from the non-bank sector is booming. Owner-occupied non-bank lending is growing at an annualised rate of about 17%, and in lending for investment housing at 4%, both well above the bank sector. Now, this is unsurprising given the different funding arrangements and restrictions between the banks and non-banks. Of course, both have responsible lending obligations, but evidence suggests that non-banks are more willing to lend at a price. APRA sort of has responsibility for the non-bank sector, but do not seem to be doing much to stem the tide. Non-banks will fund their mortgage lending either from private investors, companies, or hedge funds, rather than from deposits. And they may also securitise their loan books, meaning that they sell their loans on to other investors via the bond market. So they are not under the same controls which are applied to the banks in terms of the capital they need to hold, and this gives them greater flexibility. But rightly tighter lending, because the banks were too loose before, and falling home prices are going to hit the economy. For example, UBS said this week that February's auction bounce had given false hope to those seeking a housing recovery, and they forecast that price falls will double to 14%, with a negative spillover effect into the broader economy. Much has been made, they say, of the bounce in auctions in February 2019. However, it's clearly a false sign of hope. The rise in auction clearance rates this year is seasonal and based on a spike in under-reporting of failed auctions, with the preliminary results massively revised down 5 or 10% to the final. Indeed, while the national clearance rate rose to 48.6% in February 2019, this remains very weak around prior cycle lows after the late 2018 trend hit a record low in the low 40s. Furthermore, demand is weak as the number of auctions held in February dropped by around 30% year over year, and sales at auctions collapsed by 50% year over year. They said the UBS credit tightening thesis is still playing out, with accelerating weakness in home prices, sales, approvals, loans, and credit growth. The peak-to-trough decline in home prices is still only 7%, but looking ahead, while the Royal Commission didn't change any laws, with APRA and ASIC reinforcing sound lending practices, we expect price falls to double to 14%, making a negative household wealth effect on consumption likely. We remain non-consensus, expecting GDP to clearly slow to a below-trend 2.3% year-on-year in 2019, seeing unemployment rise and the RBA cut in November, with risks of earlier easing. And UBS has downgraded its Q4 GDP outlook following the disastrous 3.1% decline in construction activity. UBS now expects a GDP print of around 0.3%, with risks tilted to the downside. And we suspect a per capita recession is a certainty, given per capita growth was negative in Q3. However, the risk of an aggregate recession is clearly on the rise too. And as the ABC reported, there's a clear warning that we should be alert, if not alarmed, about the state of the economy, and that the risk that many jobs could be lost in the coming months is real. The roll call of big names with falling profits is a long one. Coles, Qantas, AMP, Caltex, Commonwealth Bank, Transurban, Telstra, Domain, Centre Group, Flight Centre, REA, and Fortescue are just a few. It's pretty clear the Australian economy is moderating, Perpetual's head of investment strategy, Matt Sherwood, said. The key question is, how much further does it have to go? According to AMP Capital, the number of companies reporting a fall in earnings has jumped by more than 3/4 to 41%. Those parts of the share market most exposed to the Australian economy, particularly housing and retailing, that's where the weakness is, AMP Capital's chief economist Shane Oliver said. With around 1.1 million Australians employed in the construction industry and others whose employment relates to residential construction, we can see that as potentially going to be a drop-off in hiring and potentially an increase in unemployment to come. And that doesn't augur well for the unemployment rate. More than a quarter of the people employed in the construction industry received their jobs after the start of the building boom in 2012. If employment in the sector returned to pre-boom levels, around 240,000 jobs could be lost, sending the unemployment rate soaring to more than 7%. And if that were to happen, then mortgage stress and defaults would rise and home prices would drop further. And we highlighted last week that delinquencies are rising based on data from the banks and the S&P Spin Index. So Westpac has downgraded its outlook, with housing-related weakness now expected to exert a more significant spill over drag on the wider economy. In turn, they now expect the RBA to lower the cash rate with 2 25 basis point cuts in August and November. And so to the markets. The ASX 100 was up 0.4% on Friday to end at 5,098 and is up 3.05% from this time last year. The local volatility index was down 4.76% on Friday to end at 1134 and is down 15.28% from this time last year. The ASX Financials Index was up 0.54% to end at 6,034 and is down 6.47% from a year ago. The ANZ Banking Group was up 0.11% to end at 2803 and is down 2.72% from this time last year. Commonwealth Bank was up 0.54% to 74.35 and is down 2.58% from 12 months ago. National Australia Bank was up 0.04% to end at 25.14 and is down 16.42%, not helped by more legal actions this week. Westpac Bank was up 0.19% to end at 27.01 and is 11.88% down from this time last year. The Bank of Queensland was up 1.11% to end at 9.11 but is 28.11% lower than this time last year. Suncorp Group was up 1.4% to 13.74 and is up 1.55% from a year ago. Bendigo and Adelaide Bank was down 2.43% to end at 9.62 and is down 15.08% over the last year. And AMP was up 1.27% to end at 2.39 but is still 54.63% lower than 12 months ago. On the other hand, Macquarie Group was up 24.11% over the last year and up 0.46% on Friday to end at 129.23. Genworth, the lender's mortgage insurer, was down 4.7% on Friday to 253 and is pretty much flat across the whole year. Mortgage Choice was up 1.69% to 90 cents and is down 63.91%. And McGrath, the real estate agency, was down 3.77% to 25 cents and is down 43.01% over the last 12 months. The Aussie US dollar exchange rate was 0.04% lower to 70.83 and is down 8.62% from last year. The spot gold Aussie cross was down 1.30% to end at 1,826.95 and is up 9.1% from 12 months ago. And the Bitcoin Aussie cross was down 20.6% to end at 3,801 and is 67.98% lower than this time last year. Across to the US, the S&P 500 and Dow snapped 3-day losing streaks on Friday as optimism about the prospects for a US-China trade agreement overshadowed downbeat US and Chinese manufacturing data. Despite the rally, the Dow finished down just slightly for the week after 9 straight weeks of gains. The S&P 500 was up 0.4%, its 5th gain in a row, and above 2,800 for the first time since November 2018. The Nasdaq added 0.9% on the week and has seen gains for 9 straight weeks. As Wall Street got a new month underway, traders were reminded of headwinds that could hinder the path to swashbuckling gains. One of the biggest, the US economy, continued to show signs of a slowdown. Consumer spending, which accounts for more than two-thirds of US economic activity, fell 0.5% in December. ISM manufacturing data for February missed expectations at 55.5, and the fall in personal spending was the largest since 2009, and which serves to give more credence to the abysmal retail sales figures released a couple of weeks ago. The downbeat data arrived after China's economy showed a fall in factory activity for the third month in a row. However, the pace of the slowdown had moderated, raising hopes that a bottom was perhaps forming. Sentiment on Wall Street was boosted by signs that US and Chinese negotiations are closer to reaching a trade agreement. We made so much progress last week when the Chinese were here, National Economic Council Director Larry Kudlow told Fox Business on Friday. The agreements made last week represent tremendous progress on IP theft, on forced technology transfer, on ownership, on cyber interference, and, maybe most importantly, on enforcement. Beyond trade, the markets were powered by a rise in the energy stocks, despite a fall in oil prices, on signs of weakness in China's economy. The Dow Jones ended up 0.43% to 26,026 and is up 3.54% across the year. The S&P 500 was up 0.69% to 2,803 and is up 2.6% from this time last year. The S&P 100 was up 0.73% to 1,232 and is 1.8% higher than 12 months ago. The volatility index was down 8.99% to end at 1357 and is down 25.54% from 12 months ago. The S&P Financials Index was down 0.23% to 438.13 and is down 8.51% from 12 months ago. Goldman Sachs was up 0.76% to 198.20 but remains 25.19% lower than last year. And the Nasdaq was up 0.83% to 7,595 and is up 3.57% over the year. Google Alphabet was up 1.95% to 1,148 and is up 2.05% over the last 12 months. Amazon was 1.95% higher to end at 1,671 and is up 8.42%. Facebook was up 0.51% to 162.28 and is down 9.46% over the last year. Intel Corporation was up 0.64% to 53.30 and is up 7.45% over the last 12 months. The United States 10-year bond ended at 2.76 and is up 1.75% on Friday. And the United States 3-month bond was at 2.43 and fell just a little, down 0.11% on Friday. The US dollar index against the basket of currencies was up 0.31% to 96.45 and is up 6.19% from 12 months ago. The British pound US dollar was at 1.32, up 0.06% and down 3.63% over the last 12 months. The FTSE 100 was up 0.45% to 7,106 and is down 2.71% over the last year. The Financial Services Index in the UK was up 1.24% on Friday to 663.91 and is down 2.57% over the last year. The Royal Bank of Scotland was down 0.9% on Friday to end at 263.30 and is up 0.75% over the year. The euro US dollar was up 0.02% on Friday to end at 1.1377 and is down 6.74% over the last 12 months. Deutsche Bank was down 0.04% to end at 8.24 and is down 39.27% over the last year. And the Chinese yuan US dollar rate was down 0.18% to end at 0.1491, and that's 5.51% down over the last year. Crude oil was down 2.53% to end at 55.77 and is down 6.86% over the last 12 months. Gold futures were down 1.65% to end at 1,294 and is down just a little bit from 12 months ago. Silver futures were down 2.46% to end at 15.15, and that was down 4.71% over the last 12 months. Copper futures were down 0.75% to 292, and that's down 5.12% over the year. And Bitcoin was up 0.52% to end at 3,914, and is down 62.19% over the year, but is up about 11% across February. And so that question I posed earlier, how come the markets are so buoyant in the face of the weakening economic data both here and overseas? In the Eurozone, growth is easing, and that slowing is more pronounced than even the most pessimistic expected. Both industrial production, consumer confidence, and indicators such as the trade surpluses have deteriorated sharply. Despite the bad data, the Italian recession, and the fact that the European Commission has had to revise down by more than 30% its own estimates from a month ago, Europe will still grow just a little in 2019. China continues to slow under the weight of its debt and inefficient models, but it also will grow. And the US states showed poor retail sales data, but both employment and gross capital formation show that the economy continues to expand. And the emerging countries have worsened their prospects, but have navigated the monetary imbalances that deactivated the mirage of synchronized growth in 2018. And yet markets are strongly up from that December dip. So why? The answer is central bank intervention. US, China, the Eurozone, and Japan shows their aggregate money supply peaked at $73.1 trillion in April before dipping to $69.8 trillion in mid-November and then rebounding to as much as $72.6 trillion at the end of January. Since the end of December, stock markets have rebounded strongly because the data, although poor, is not as bad as feared, and mainly because the Federal Reserve changed its tone on the number of rate hikes. The ECB announced that it would be much more accommodative, and the Central Bank of China introduced the largest injection of liquidity in 5 years. It's this growth of the global supply of money by central banks looking to first combat the financial crisis and then keep their economies from falling into recession that has been the key reason for the stellar performance in riskier assets. And just looking at a few selected economies, the money supply in Australia over the last year grew by 3.01%. New Zealand grew by 5.32%. Canada grew by 5.04%. The United Kingdom grew by 3.38%, and the United States of America grew by 4.42%. And to underscore the point, the bulk of that growth comes from increased public and private sector debt. And that growth is evident in the more than doubling of the money supply index from $35.3 trillion in late 2018, just a few months before global stocks embarked on a rally that would see the MSCI more than double itself by early 2018 before last year's rough patch. In other words, the global markets are reacting to the cash sloshing around in the financial system looking for a home. But it's all artificial. And yet expect more ahead as the central banks try to manage the massive debt burden which underpins the expansion and lower interest rates later. But as a result, the crash when it comes will be deeper and more significant. And the truth is, central bankers are stacking the deck to support the financial system. Despite the spillover effects on many individuals and households, equality has been banished in favour of expediency. And as you know, I do not expect this to end well. But the rate of money supply growth may mean it's later and more extreme, and Australia appears to be leading the way down. We will see. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. If you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you haven't already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.